Tug of war currently underway in this stock market. What that means to your money. It was on full display yet again, especially into the close today. Let's ask the famed Wharton professor, Jeremy Siegel. He is back with us today from Philadelphia. Professor, welcome back to Overtime. It is nice to see you.
Nice to see you, Scott.
I do feel like we had an old-fashioned tug of war here, especially going into the close. Those who want to take the market higher, even if it's a bear market bounce, and those who say we haven't gone down hard and fast enough to really justify where we are.
Yeah, well, the first 3.5, 4 months of this year, the decline was because of the rise in interest rates. The recent weakness is what I call the numerator, and that is earnings, because in the price of stocks is earnings over interest rates. And, we've had that rise from the Fed, and now there is, for the first time, concern about that earnings. And by the way, earlier today, I look at the money supply as a very important indicator. We had, at 1 o'clock announcement today, the second largest monthly decline in the money supply in more than 60 years. Wow. You talk about contraction. I mean, the big mistake of the Fed was 2020 when they pushed too much money in 2021. We don't want to make too much of a mistake. Are they going to try to just take it all away in 2022? I'm beginning to get a bit concerned about overreaction. And maybe some of the weakness we see in the economy is because, the Fed is withdrawing liquidity perhaps a bit too quickly. I think they could go.
Professor, you've been the loudest person on the network over the last couple of months saying that the Fed needs to do more. Now you're telling me they're doing too much. They just got started.
I know. Well, first of all, their talk of what they're going to do, we've seen how that has tightened the markets. Bringing the long bond over 3, bringing mortgage rates over 5%. I mean, you saw home sales today, Scott. I mean, you take a look at some of these monthly reports. I mean, a Snap is at a warning. Is what we're seeing from the retail is a warning. Now, listen, they definitely have to move up 50. But their July meeting, and I would just recommend that if they would look at the money supply, they wouldn't be in the position they are today back in 2020 and 2021. Are they going to say, we're going to get the money supply all the way back down? You are for sure going to have a recession, and a bad one, in 2023. My feeling is that maybe there's a lot of inflation in the pipeline. Listen, they can't do a lot about it. That's all really because of the liquidity they put in. It's not like steering a wheel in a car. Just turn this lever, inflation goes down to 2%. No. Maybe they should accept the inflation in the pipeline, go easier, get us back down to the 2 to 3% long term that they want. But right now, as I said, that was a pretty shocking statistic for me because, I based all my inflation forecasts 2 years ago and 1 year ago on this money supply. I had never thought that I was going to see it decline.
Wow. So pulling money out of the system at the same time that the economy may be weakening faster than people initially thought. You mentioned the home sales report. Manufacturing miss, services miss, composite PMI miss, Richmond miss, your new home sales miss, month over month miss. But let me read you this. This from Bill Ackman today on Twitter, Professor, in terms of what he thinks would stop what he calls the market spiral. What would end it? It ends, he says, quote, when the Fed puts a line in the sand on inflation and says it will do whatever it takes, and then demonstrates it is serious by immediately raising rates to neutral and committing to continue to raise rates until the inflation genie is back in the bottle. Stocks of real businesses are cheap once again. Markets will soar once investors can be confident that the days of runaway inflation are over. Let's hope the Fed gets it right. I hear you saying to people like Bill Ackman that is way too much from the Fed, and now you're worried that they're going to overdo it.
Well, I'm just saying that they got to keep their eyes on two things. One is the interest rate, and the other is the supply of liquidity. Don't forget, we moved from unbelievable fiscal stimulus to a situation, biggest one-year reduction that we had since World War II in the budget deficit. There's no stimulus coming from anywhere with restriction. There's a question. A lot of that inflation is in the pipeline. You want to absolutely crush the economy to get rid of it right away, or say, I'm going to let some of it just move through in my thought of getting back to the path. The past mistakes of the Fed, we're paying for those, and the only way they can fix it, immediately is to cause an extremely severe recession. My feeling is, listen, that, I've been saying go to neutral, that they've been too slow. I'm just saying they've got to look at money as well as interest rates. They never talked about money. Had they talked about money in 2021, we would not be in this situation today.